What if I told you that the mainstream financial media is completely missing the biggest EV story of the decade? Tesla might be trading near all-time highs, but a massive rival just posted a staggering 96% growth and is quietly building an unstoppable physical moat that Elon Musk simply cannot copy. We are talking about 23-hour robotaxi uptimes, record-breaking energy infrastructure, and a multi-brand takeover of the entire market. My name is Mark. Watch till end because this analysis will blow your mind. Please like and subscribe for more update. Tesla's China nightmare, why NIO is now unstoppable. In my opinion, this research completely flips the conventional Silicon Valley narrative on its head. I always hear that the autonomous vehicle race is purely a software play, right? Like, whoever codes the best AI wins the whole board. But this data points to something entirely different, a physical, operational moat that NIO is building while everyone else is just staring at screens. Exactly. So let's get right into point one, the delivery reversal. Because the financial markets are currently pricing Tesla near historic highs, but operationally, on the ground in China, things are looking a bit shaky for them, aren't they? In my view, they really are. Look at the 2025 full-year milestones. Tesla's domestic retail volume in China actually shrank by 4.8% year over year. Their market share dropped from 10% to 8%. Meanwhile, NIO didn't just survive. They achieved a massive 46.9% year-over-year growth, delivering over 326,000 vehicles. Wait, a 46% increase? That's not just a blip. No, it's a trend, and it carried right over into January 2026. This is where it gets crazy. NIO delivered 27,182 vehicles in January alone. That's a staggering 96% year-over-year increase. And Tesla? Their China retail deliveries plummeted 45% to just under 18,500 units. Tesla is basically being forced to rely heavily on exporting cars out of their Shanghai factory just to keep the assembly lines moving. So Tesla is essentially using China as an export hub because the domestic buyers are shifting? That is a huge structural signal. But why? I mean, Tesla has massive brand cachet. Is it just the cars? Which brings me to the second point in my analysis. A masterclass in multi-brand expansion. Yeah, and this is where Tesla's strategy is starting to show its age. Tesla is essentially fighting a massive multi-front war with just two aging weapons, the Model Y and the Model 3. They don't really have a segmented strategy. NIO, on the other hand, is deploying what they call a multi-layered product architecture. They aren't just one brand anymore. They are capturing every single price segment to build a massive total addressable market. Right, so let me break that down. Because I know they have the core NIO brand, which is pretty expensive, right? Exactly. The core NIO brand dominates the premium segment, anything over 300,000 RMB. Vehicles like the ES8 SUV, which just hit record highs in Q4, and the ET7 executive sedan. They hold that luxury prestige, but you can't get to massive global scale just selling luxury. So they launched Onvo. Onvo. I've been seeing that name pop up everywhere in the EV forums. Onvo is their strategic mass premium brand. It is laser targeted at the Tesla Model Y. It broadens NIO's market reach with structurally better factory utilization without diluting the luxury status of the main brand. And then below that, you have Firefly. Let's talk a little more about Firefly, actually, because launching a brand new car line in Europe right now seems, well, risky. The European market is notoriously tough to crack for outsiders. It is, but Firefly is entering at a highly strategic price point. I'm talking about an entry-level compact urban EV designed for margin optimization. European cities have tight streets and a strong preference for smaller hatchbacks. By keeping the margins optimized through their shared platform architecture, NIO can offer a premium-feeling small car at a lower price tier. And they are backing it up with serious marketing. They've already launched a major offline ad campaign in Europe with the tagline, "Shine bright like a firefly." So they are attacking the luxury market with the core NIO brand, the family SUV market with Onvo, and the compact commuter market with Firefly. That is a pincer movement if I've ever seen one. Precisely. And every single one of those cars feeds into the same energy ecosystem. Which brings me to the third and probably most important point. Yes, point 3, the autonomous utilization advantage. My analysis suggests the true race for robotaxis isn't about AI software. It's about asset utilization. What does that actually mean in plain English? It means a robo-taxi is only making you money if it's moving, right? If it's sitting still, it's a liability. Let's look at a standard fast-charging EV. Even under the best conditions, fast charging takes 25 to 35 minutes. You have to factor in driving to the charger, waiting in line, and honestly, the physical friction of handling heavy cables and queuing. Because of all that charging friction, a fast-charging robotaxi maxes out at roughly 18 hours of actual revenue-generating uptime per day. 18 hours. Okay. A NIO vehicle doesn't charge. It swaps. It autonomously enters a swap station, communicates with the station's robotics, exchanges its depleted battery for a fully charged one in roughly 3 minutes, and returns to service immediately. No human intervention, no heavy cables. Let me really break down the math there for the listeners who might be skeptical. Sure, imagine you own a fleet of standard robo-taxis. Over a 24-hour period, a car might need to charge 2 or 3 times. All that dead time, waiting, plugging in, sitting there, adds up. So you only have your asset working 18 hours. Now imagine your fleet is NIOs. The car detects its battery is low, drives in autonomously. The robotic floor swaps the battery and the car drives out. 3 minutes. Because of that structural advantage, a swap-enabled robo-taxi can realistically operate closer to 23 hours per day. Wow. So, 23 hours versus 18 hours. That's, what, a 25% difference? Exactly. A 25% uplift in revenue from the exact same vehicle asset. In fleet economics, where margins are everything, that gap alone is the difference between a highly profitable business and a failing one. Intelligence matters, sure, but if your genius AI is parked at a supercharger for 1 hour, it's not making money. Autonomy without uptime is simply parked intelligence. I think that was a line from my analysis, and it is so true, but setting up those swap stations has to be incredibly expensive. Which brings me to the fourth pillar, the ultimate infrastructure moat. It is massive and capital intensive, but that's exactly why it's a moat. Self-driving software is ultimately fungible. If someone writes better code, it eventually gets copied or licensed. Software diffuses rapidly, but physical infrastructure, you cannot easily replicate a nationwide automated energy network capable of sustaining near-continuous autonomous operation. And my analysis mentions energy arbitrage. I want to dig into that, because right now, if I plug in my EV at noon on a hot summer day, I am paying peak grid prices. Exactly. And if a robo-taxi fleet operator has thousands of cars fast charging at noon, they are paying peak daytime rates. But NIO's swap stations charge batteries slowly overnight when power is cheap. Then, they deploy them during the day. This lowers the energy cost per kilometer compared to fast charging, which is also better for the battery health, right? Spot on. Slow controlled charging off vehicle extends the lifespan of the battery. So NIO pays rock-bottom prices for power at night, stores it, and then when a robo-taxi pulls in at 2 p.m., it gets a battery full of cheap nighttime energy. It is a structural financial advantage. And the scale of this network, my analysis mentions the Lunar New Year in 2026. Oh, the Spring Festival data was unreal. That network's resilience was on full display. During that week, average daily swaps reached over 141,000. And on February 19th, they hit an all-time record of 165,525 swaps in a single one day. 165,000 swaps in one day. That is staggering. Let's bring it home with the fifth point. Margin expansion through vertical integration. How do they actually translate all this scale into profit? As NIO scales, their profit margins are set to inflect positively because of deep vertical integration. Take their self-developed tech. By designing their own in-house smart driving chips, they reduce their reliance on expensive third parties like NVIDIA. It stabilizes their bill of materials, or BOM cost, so it makes the cars cheaper to build and insulates them from supply chain shocks. Yes. And then I layer on software monetization. Features like their NOP Plus subscriptions bring in high-margin, recurring software revenue layered over the hardware. And they keep the user experience fun with things like the NIO Smart Cabin Spring Festival Easter egg. Yeah, it's a playful rollout they pushed for the holiday, adding festive features to the infotainment system. It shows they are building a highly engaged ecosystem, not just selling a car. This really paints a completely different picture than what you see on standard financial news. Tesla is obviously a global giant, but my analysis makes a very compelling case that NIO's trajectory is currently unmatched. That's the core of the thesis. If you look at the raw numbers, the delivery reversal, the ONVO ramp, the 23-hour robo-taxi uptime, the in-house chips, they are building a formidable competitive moat in the EV space. It's been an incredibly eye-opening discussion. Thanks for following along with me. Would you like to hear more about how this battery swap model impacts the upfront purchase price for everyday consumers? Let me know in the comments. See you next time.